Welcome to our panel on the economics of cybersecurity. We're blessed to have a great team here from the University of Maryland, which is going to help show you why economics matters to all of us in the cybersecurity world. I was lucky enough to work with Larry when he was in charge of all of us PhD students at the University of Maryland, and so it's fun when you get into the cyber world to reach back into some researchers that have been doing some outstanding work on cybersecurity and on accounting and information assurance since the late 90s, I would say, but maybe it's the... but we've got Larry is going to be starting out, and then Marty and Leigh and I will all come up onto the panel and have some discussion. So we'll have an overview, and then we'll go into the panel discussion. So without further ado, Larry.
Okay, thank you very much, Andy. Appreciate the opportunity to talk to you folks. So let me give you a little background first. So 20 years ago, I was taking economic models and applying it to accounting and finance. My PhD's in economics with a mathematical focus from Rensselaer. Any Rensselaer grads here? Engineers? Any engineers here? Okay, so you know Rensselaer is. Somehow I stumbled upon the notion of cybersecurity and discovered there were no economic models for how much to invest in cybersecurity. I thought that was an important issue. How much do you want to invest in cybersecurity? I see all these companies that are having breaches, okay, and I read these articles go back 20 years ago, 1998, 99, okay, and they talk as if all these companies are going to go bankrupt, right? As it turns out, they don't, and I'll come back to that later on. And so what I started thinking was, so how much should they invest? A company like Target's can't take all their money and put it into cybersecurity. That's not their business. So there's got to be some decision rule for how much they're going to invest. So that's how I got into it. And very quickly, once we got into it, actually NSA heard about our work and started supporting us. They came to us. And since then, we've actually had support from DHS, okay, and I'm currently being supported to some extent by NSF. So I'm actively involved. It changed my whole career because I stumbled on this area that no one was doing any work with economics. I immediately went to one of my colleagues who's sitting up front here, Marty Loeb, and told him what I was interested in. And at first he says, I'm not interested, but finally I got him interested in it, okay? And so we actually developed an economic model called a model for how much to invest in cybersecurity. And the literature, we did not name it, but the literature started calling it the Gordon-Loeb model. So I'm going to talk about that model, but I'm going to talk about how that model can help, okay, to implement some of what's going on with NIST. So, but before I tell you that, let me just say one quick story that I think might resonate with some of you. So about, I'd say 17 years ago, I got a call from someone who was in charge of security for a Fortune 500 company. All right, and he wanted to put in, this is maybe 17 years ago, he wanted to put in an upgrade to the network, the security of the network, and he went to see the CFO and asked for a $10 million upgrade. And the CFO said, where's your business case? And this person who came to see me, I have a standard policy. The policy applied to all of you as well. If you want to talk to me about anything I'm talking about here, I'll be glad to buy you lunch if you come up to the campus. All right? And so he came up to campus, we had lunch, and he says, doesn't the CFO understand the importance, of security for the internet? And I said, of course he does, but don't you understand economics? And if he gives you that money, he's taking it from somewhere else. So it's a resource allocation decision. And that's what we're all about. We talk about how much do you allocate to cybersecurity. What's the real cost of a cybersecurity breach? If I asked you folks, I haven't gotten to my slides yet, okay? But if I asked you folks to tell me, can you name a company that went under? I know we got a lot of computer science people here, engineers. Can you name a company that went under during the financial crisis of 2008? Can anyone name any company that you know of that went under as a result of the financial crisis of 2008? Lehman Brothers, perfect. Can you name a major corporation that went under because of a cybersecurity breach? We got computer science people here.
Try that.
Can't name one major corporation. So when we had so what I keep saying is, I hate to see companies have breaches, but, where? Well, are they a company listed on the New York Stock Exchange in the US? Okay. Well, the point I like to always make is we need a big company that everyone's aware of. I'd have to go check that one out. All right, was that really went under? It wasn't from cybersecurity, but was it? I'd have to check that out. The point I'm trying to make is, okay, that these breaches are really significant, they're important, they cost companies money, but until we have a major corporation that really goes under, we don't seem to get the attention of everyone. So let me tell you what I'm going to do here. So I'm going to talk a little bit about the NIST Cybersecurity Framework. Are most of you familiar with the NIST Framework? So I'm not going to read you my slides. I put together some slides that if Andy wanted to put it on the web, that way you'll have something you can look at, okay? So we all know that the NIST Framework was the result of President Obama's executive order, right? That President Obama in 2013 tasked NIST to come up with the cybersecurity framework, gave NIST 1 year. NIST within 1 year came up with the framework, right? And so the framework actually came out. Okay, well, let me go back one. The framework actually came out in 2014, right? And since then, they've updated it, and I'll talk more about it. And the framework immediately took off. I was involved in meeting with some of the people in NIST, talking about the framework, and quite honestly, my attitude was this will never take off. So if you think I think I know everything, obviously I don't, I was wrong, okay? But one of the things that happened that really gave the NIST framework a tremendous push, okay, and that was when President Trump, in Executive Order 13800, said all government agencies have to use the NIST framework. The externality, or the spillover effect from that, was that all companies that want to do business with the government better be using the framework or some framework that's consistent with it. And as a result of President Trump's Executive Order 13800, we now see everyone talking about the cybersecurity framework. And so the framework, what is it made up of? Okay, so the framework basically talks about core, implementation tiers, and profiles. And I won't define these for you, but what I'm really interested in is the implementation tiers right down here. Okay, and if you just take a look at that little sign there, they basically have 4 tiers. And what NIST talks about in their framework is that you don't have to be at tier 4, even though a lot of companies think they have to be there, but it's really a cost-benefit decision on whether you're at tier 1, tier 2, 3, or 4. But they never explain how you can do cost-benefit analysis to decide what tier. In fact, just the opposite. I've had the head of the NIST framework come to my class and talk about this, and what he basically argued was it's up to each company to decide how to implement the different tiers. And that, on the surface, makes a lot of sense, but there's no guidance at all in how you'd come up with a cost-benefit framework. So when I heard that, my first thought was, well, maybe you could use our model as a framework to, for companies to look at how to come up with the right tier. So that's what this talk is really about, using our model for how to go through and figure out what tier is best for us. Keep in mind, it's a cost-benefit decision. Right? So you can just look at this, the tiers. Basically, the tiers go from tier 1 up to tier 4, and the difference is in terms of rigor and sophistication of the tiers. Of course, what that means also is there's a difference in cost. As you get more rigorous and more sophisticated, as you move up in tiers, you have more costs. NIST explicitly points out, okay, that if you want to move up from one tier to the next tier, okay, it's a cost-benefit decision. You make the decision how to do it, but it's a cost-benefit decision. Every company doesn't have to be at tier 4. And in fact, for small companies, it probably doesn't make much sense. Or certainly, they can't afford it on a cost-benefit basis, right? So what I've got here is, if you just take 1 minute and take a look at this, basically what NIST is saying is that you've got to ask yourself, how much should our organization invest in cybersecurity risk management? Keep in mind, for different tiers, you've got to invest more. But nowhere does NIST tell you or give you any kind of guidance. They purposely do not give guidance. And the reason they don't, for good reason, and that is they feel it's up to you as a company to decide how you're going to go through your cost-benefit analysis. right? But they explicitly say in several different places, if you read, okay, version 1.1, the second version, originally came out 1.0, they explicitly say it's a cost-benefit decision, all right? So my thought was, well, I agree with that, but the question really is, for companies trying to come up with what tier, you know, how can they go through this? So the first thing I thought about was, so for different tiers, it's going to cost you different amounts as you move up in tiers. And depending on it's company dependent. So companies have to decide how much would it cost me to get to a different tier level, right? And then they have to ask themselves, okay, how much are we spending right now, and is it worth going to the next level? And that's a cost. You know, what's the incremental benefits versus the incremental cost? Basic economics question, right? So that's how I got interested in it, and I turned around and I said to Marty, okay, and to Lay, I said, we can apply the model to the NIST framework in terms of tiers, right? So that's the whole purpose of this little discussion. All right, so one of the things I often get accused of is that, well, you're lost in your models, okay? And in the real world, you know, can you really use these things, okay? And the answer is, I fully understand that a model should be considered as something that you use as a supplement to, not, I mean, as a complement to, not as a substitute for some sound business judgment or sound decision making. So in other words, you think of these models as being a complement to, not as a substitute for making these decisions. And the reason I have this little slide up here is I want you to know that the Wall Street Journal agrees with that. They asked us to write a paper on the Gordon-Loeb model. The Financial Times agrees with that. The Better Business Bureau in 2017 came out with a report and recommended for all small businesses within North America to consider using the Gordon-Loeb model as a framework. Now, I know my wife would say if she were here, well, that's typical Larry. He's, you know, how great the model is. But I'm trying to let you know that people outside of academia have recognized that the framework, and I think of the model as a framework, the framework is valuable. Although the model itself is a mathematical model that actually uses some calculus to get to a solution. But it's the framework of the model that really is so valuable as I see it. All right, so that's a little of the mathematics of it. I'm not going to discuss it. All I'm going to say is that there's some mathematics. If you want to go back and read the original article, which was published in the ACM Transactions on Information System Security, a major computer science journal, that was all mathematics, right? Excuse me? TSEC, exactly. All right, so anyone who's in computer science, they know what that journal is. Okay, but the basic idea of the model is, what you're saying is that there's an expected loss associated, okay, with a breach. And that loss is based on the vulnerability, okay, and I'm using vulnerability to include threat, so vulnerability and threat, so my V is a vulnerability, okay, multiplied by the expected value of the information you're trying to protect. That's kind of your expected loss, right? And so if you can invest more money, what you should be able to do is reduce that vulnerability. So the basic little mathematics here basically says, look, if you multiplied the vulnerability times the value of the information, you get the expected loss. If you invest more money, you reduce that vulnerability, and that reduces the expected loss. And that helps you to figure out how much to invest, which we call Z. So that's all that math says. Right? And there are three major components of this. One is, what's the value of the information you're trying to protect? Right? What's the vulnerability in terms of vulnerability, probability of a breach? So I tend to think of vulnerability and threat as a probability of a breach. So that's the intuition there. And then lastly is, what's the productivity of making more investments? So you need a productivity function. If I invest more, how do I reduce V? So that S of ZV is really a function that talks about how I can reduce V. It's the productivity of additional investments. So that's the idea underlying the Gordon-Loeb model. All right? So basically what it says is these benefits from investing more are increasing at a decreasing rate. Simple economics, basic economics, you know, diminishing marginal returns, right? And what it also says is that you can actually figure out that there is some optimal level of investment through mathematics. and that's what we did, but that's not what I want to talk about. All I want to say is that intuitively, if I invest more money, I can reduce the vulnerability, right? But I reduce it as I invest more money, okay? The reduction gets smaller and smaller. The benefits are increasing at a decreasing rate, right? And there's some point where it doesn't pay to invest anymore. Now, when I talk to people in computer science, before we talk about economics, they'll often say, well, keep investing up to the point where you expected loss. But that's not true. What you want to do is you want to take into consideration the function for increasing at a decreasing rate. So assuming you pick your initial investments wisely, okay, you'll get more for your money initially than later on. All right? So forget about the mathematics, but the point of this slide is to say, so now we decided, okay, we're going to integrate our model into the NIST framework. And I'm going to eventually show a little graph that'll sum it up. All right? So skip those two. All right? And we made up an example. And we made up an example that includes what we call the productivity function. And so if you look right here, that's the productivity function. And what that basically says is, without going through the mathematics, it says if I invest more money into cybersecurity, I reduce V by some certain amount based on this function. So is the intuition clear? So that's what it's saying, okay? All right, so what this slide shows, and I got one more after this. I got actually two more. Okay, what this slide shows is, so let's say that the vulnerability is 30%, 0.3. All right, I can then say, okay, for different levels of value of information, I can compute the optimal amount to invest. So what this slide shows is the optimal amount to invest, the curves, at different V's, V equals 0.5, 0.3, and so on. So it shows at different V's, right? Okay, I can actually figure out what would be the optimal level of investment depending on the value of the information I'm trying to protect. And as the value of the information gets greater as I move along here, okay, so that I'm investing more. And I can also, let's go back to what I said 10 minutes ago. I can also start off and say, so for our company to get to tier 1 or tier 2 or tier 3, how much do I think it's going to cost? So what we've got over here is we've got, this is for tier 1, tier 2, tier 2, tier, do I have it? Tier 3 and 4, right here. Tier 1, 2, 3, and 4, right there. All right? So now what I can do is I can see where am I in terms of how much I'm investing, okay, at an optimal level relative to the different tier levels. And does it pay to increase it? So let me take one of those and isolate it so it'll make it a little clearer. So what I've got here is, okay, a slide that shows if vulnerability is 0.3, okay, I can then plot a curve that would show me, okay, show us how much I want to invest, an optimal level of investment at different levels of value of information. If I plot against that how much it costs for our company to get to tier 1, 2, 3, or 4, I can see where I fall, in terms of what tier, and whether or not it pays to invest any more to get to the next tier level. Now, it all is based on your estimates of your company, so I'm not taking away the notion that you make the decision in your company. In fact, what you can do is a simulation around this. You can try different levels. But at least you have a way to try to implement the NIST framework in terms of tiers on a cost-benefit basis. Now, I know I went through a lot quickly, so let me just summarize and say, okay, there are some key insights to all this when you think about, what the model shows us. The key components are what I've got up here: potential losses, vulnerability threats, productivity investments. We have some conclusions which you don't have to worry about. Basically, we showed that on average, one of the key ones is, on average, you don't want to invest, okay, more than 37% of the initial expected loss. We can prove that mathematically, and we do. That's in the article. If anyone's interested, send me a note. I'll be glad to send you some papers, okay? And Okay. One reason I put this in is I don't want you to think I'm lost in the model. I understand it's a framework, and I understand how you're going to apply it in your company, or anyone's company, will be a little differently. But the framework is very useful. So what I like to do is, well, let me go back once, just one more time. I like to go back and let it just dance one more time. I really believe that economic models should be viewed as a complement to, not as a substitute for, sound business judgment. I am not lost in the model. Right? Now, there are 4 steps you can follow to use our model. And rather than me going through these, I'm going to ask for some help. I got a 3-minute video that's going to show you how you could use the model, which I made. It's a YouTube video. I'm sure the other one was very good, but I think this is better. That's me. Okay, can I sit down? The photo's better, right? Cybersecurity breaches are common in today's interconnected digital world. Anyone who doubts this claim need only ask Target, Home Depot, JP Morgan Chase, or the US government. Despite the risk to a corporation's earnings and reputation, not to mention the potential liability and loss of secret formulas, corporations tend to underinvest in cybersecurity for several reasons, including the fact that hackers are invisible. You won't see them standing outside your window. Furthermore, you don't know where or when they will attempt a cyber attack. Another reason firms tend to underinvest in cybersecurity is because these investments result primarily in cost savings rather than generating revenue growth. The above notwithstanding, corporations need to invest in cybersecurity. Fortunately, there is a framework that can help firms derive the appropriate amount to spend in protecting their information from cybersecurity breaches. The literature has baptized this framework as the Gordon-Loeb model. The fundamental principle underlying the Gordon-Loeb model is that when making cybersecurity investments, the benefits should be greater than the costs. In deriving the appropriate level of spending, the Gordon-Loeb model takes into account the potential loss from a cybersecurity breach, the probability of a breach, and the way cybersecurity investments reduce the probability of a breach. Based on the framework, there are 4 steps that organizations should take to determine the cybersecurity spending. Step 1. Segment information sets and assign each set a value. In other words, estimate the value of the information you are trying to protect. Step 2. Estimate the probability that an information set will be breached and assign each set a vulnerability score. Step 3. Develop a grid ranging from low value, low vulnerability, to high value, high vulnerability information sets. By combining steps 1 and 2, you end up with the expected losses for the different information sets in your grid. Step 4. Put your cybersecurity dollars where they'll be most productive in terms of reducing the expected losses from a cybersecurity breach. When taking the 4th step, keep in mind that the benefits from investing in cybersecurity increase at a decreasing rate. 2 general findings from the Gordon-Loeb model are: first, cybersecurity spending generally should not exceed 1/3, or roughly 37%, of the total expected losses from cybersecurity breaches. Second, the optimal amount to spend to protect information does not always increase with increases in an information set's vulnerability. Although not a panacea, the Gordon-Loeb model should go a long way toward helping a firm derive its cybersecurity investment needs. Thank you very much. Okay, so I'm going to end up by just saying, I know I get accused of being lost in this model. Okay, and I get accused of, can someone really use it in the real world? Okay, and my answer to that is, if you don't believe
Hello,
me,
it's Tyler
Wall
Moore
Street
from the
Journal
University of
thought it was
Tulsa.
worthwhile,
Today we'll be talking about
Financial
security
Times
investment
thought it
models.
was worthwhile, Better Business Bureau in
So
their
the overall
report
view,
recommended the model.
overview of the slides
take
here.
for
First,
all
we're going to
small
introduce the
businesses in North
canonical
America.
model for security
Thank you very
investments,
much.
which comes from Gordon-Loeb. Then we will talk about subsequent video,
Oh, we're going to
some
Yep.
simplified investment models.
Yeah. No, you go. No, get.
So we'll start out with some discussion, but then if there starts to be some questions that you all have, we'll be ready to take some questions.
Since I gave the talk, I would suggest you talk to them for the questions, especially the tough ones. The easy ones I'll take, but we'll give them the tough ones.
So-
Before you go in, I should have mentioned one thing. Although it's the Gordon-Loeb model, since then we've published a ton of papers related to it, and Joe Lay, or as we call her, Lay has actually been a key part of all those publications. She's an integral part of everything we've done right after we developed the model.
Thanks. Well, obviously interested in any comments you have, but one of the things that comes to us is when you think of them recommending this model for small businesses, what about varying countries and using this model for country investment versus company investment?
So I've given this talk in the Netherlands, I've given this talk in the UK, I've given this talk in Japan. In Japan, for example, it was to engineers and computer scientists. In the Netherlands, it was a group like this group. So they apparently think that this model has some use. And every one of those talks has been about what I call insights from the Gordon-Loeb model, how you might be able to use it. Okay, so I think it has, it's a framework. Let's go back. The framework says what? Well, it says you got to consider, this is just intuition. You got to consider, okay, the value of the information you're trying to protect. You got to consider, okay, the vulnerability to a breach. Okay, and then you ask yourself, do I want to put more money into it? Do I want to invest more? And the way you make that decision is, so what do I get for extra dollars? What's the productivity of the investment? That's our productivity function. So my answer would be, and I'll let them, is that absolutely this has application to any kind of environment, private corporations, small companies, government agencies. We've been contacted by almost every major U.S. government agency to talk about it. Want to add anything?
I think if you're talking about a country protecting itself, national defense, we have in the model basically it could be a large loss, but something that's finite and we can at least estimate. When you're talking about loss of life and then losing the whole country as a whole, there are limitations to the model.
Lee, you want to add anything?
I think the whole idea about the model certainly apply to most countries. I would say it's an economic decision. What would be different in different culture, different nation, probably is the value of the information. For example, if we stay in Europe, then there's this new GDPR came out. So the personal information, personal data, once you lost it in Europe, probably it's going to cost the company a lot more. And I think United States is also following suit. But if you go to some other less developed country, then the L probably will be very different. Also, the vulnerability depends on the infrastructure. It will be different. So I think you have to, again, it's a situation country by country approach, but the whole idea is pretty much the same.
Yeah. So have you, as you're taking a look at what, we invest 37% we're a small company, but what about the differences in sectors where you have a more active ISAC, or how could you do a value of friends in this kind of a model?
So with ISACs, I gave a talk at the national meeting of the Financial Services ISAC, and to me, they're probably the most, I don't mean to offend them, most sophisticated of the ISACs, or certainly among the most, and they're particularly concerned about this. And one of the things in their situation is when they think about breaches, companies think about breaches differently in terms of risk. Some companies think about the risk in terms of the expected loss. Others think about it as what's the smallest probability of a zero loss, because any loss, the reputation effect is so damaging. And the financial sector, okay, financial services, Isaac, they're particularly concerned about that. So they put a high value on their information. And so remember, the expected loss, however you look at it, is a combination of the probability of a breach and the value. So it's a trade-off between those two. So one of the questions, it's not exactly what Andy asked, but was, so what about small companies? Okay, a lot of small companies think that they're not vulnerable because who's going to want their, their assets or their information? It could be just a list of their credit cards. Well, the answer is they're a soft target. So even though the value of the information might be lower, the probability of getting into them might be very high. So it's a trade-off between those kinds of things. So that's why I say every company has to decide for themselves. The framework doesn't give you an answer for any company. It gives you an approach for your company.
I would just mention about the 37% was the maximum, okay, that there are, for many, in our mathematical model, for many parameters, it's quite a bit less than 37%. Right. Maybe talk a little about how we came about. We had an optimal amount, a function of how much to spend, and then, I don't know if Larry wants to talk about it. We were looking for a decision rule. So it was done by simulation, a lot of looking at changing the parameters, and I noticed that it was never greater for one of the functions, 37%. Once you have an idea that you can do something, that there's a rule, then you look to prove it mathematically.
So if I can tell the story about the 37%. So I teach a seminar at the doctoral level, and I cover some economic papers. And any of you know what real options are in economics? Real options are, that I can make a decision to invest now, or I can defer the investment. There's what they call a deferment option. And there was a paper published in the Quarterly Journal of Economics years ago by a well-known economist, and it was all mathematics, but at the end they came up with a decision rule. And the decision rule was, on average, the net present value, has to be at least equal to the cost of the project. So when Marty and I got into this initially, and we were looking at the mathematics, I said to Marty, it should be obvious I'm the talker, they're the brains here, right? So when we got into it, I said to Marty, we need a decision rule, and I referred to this paper, which he hadn't read, and I gave him the paper to read. And he says, that's crazy. You don't start off with the end result when you do research. And I said, I know that, but I says, we still need a decision rule. And so we kept meeting for about 9 months every week for lunch to talk about this. And one day he walked in, and Marty's a good mathematician, and he walked in and he says, I got a eureka. He said, we not only got closed form solutions, but I got a decision rule for you. It shows that, to be honest, what the answer really is you never want to invest more than 1 over E. Okay, so if that's what, 36 point something percent. That's the mathematical solution. That's why we use 37%. And so we came up with my decision rule. We published this paper in a computer science journal, okay, and for the next year, there are all kinds of papers coming out and say, these people must be crazy, okay? It's not possible 2 guys from the business school come up with a model that all of us in computer science could actually use. So they went through trying to disprove it. And they especially didn't like the decision rule. They really disliked that immensely. Eventually, a mathematician from France and from Russia around the same time, about 3 or 4 years after we published our original paper, they both came out with articles and said something like the following: these guys stumbled on something that's far more powerful than they even realized. So I went into Marty's office and I said, they point out we stumbled on something from I said, maybe they're right, but Marty's a good mathematician. He says, no, they're wrong. The mathematics is right. And so what they actually did was they showed that the model was more generic than we had even thought it was. So if anyone's interested, I'll be glad. If you got an engineering background or any kind of undergraduate background in calculus, something you can read this easily. It's easy. I was able to read it with no problem. So and develop with Marty.
A question right here, and then we'll... We're-
I think they want to record the word. Oh, okay. First of all, thank you. Tremendous model. Really like it. I wonder if you could comment, elaborate rather, maybe a little bit more about how you would go about determining what appears to be relatively, or to include a lot of subjective components on either the value of the information, okay, a lot of which would be stated in the negative. If I lost it, I lose reputation, something like this. So there's some difficult to quantify kinds of things there. And then the cost of the cybersecurity. Of course, when they had the WannaCry breach in May of 17, that patch had been out since March, and a lot of the companies who were victims had not applied the patch, in large part because it takes a lot of staff, if you have a big network, to patch all those systems, and patches just keep coming. So you add people, the biggest cost. So there's a lot of cost in cybersecurity that are difficult to measure. I mean, we could talk about the training requirements, et cetera, to bring people up to speed. So how would you get fidelity if you're running a business on cost of cybersecurity? What would be the components of that? Have you looked into that? And what would be the components of the value of information, particularly if that happens to be perishable? Thank you.
You want me to answer it? So,
Sure.
so I get this question on a regular basis, okay? So the beauty of my talk is I say, you know, I can tell you how to use the model, and I can walk you through what you got to consider, but you got to tell me what your information is worth, and you got to tell me what you're doing already in cybersecurity, and what you could add to that, and what you think it would cost. It would be different for each company, okay? However, in terms of the value of the information, let me say the three of us have done lots of studies to look at the impact of breaches on major corporations that are publicly traded, and in that case, we've looked at the impact on the stock price. So that's one way for a publicly traded company. We've looked at the impact, and surprisingly, for most breaches, it's not statistically significant. There is a negative impact, but not statistically. For some companies, it is. But the truth is, I don't have a crystal ball where I can tell you that here's how you do it, but I can walk you through it. And so the analogy I like to make, if I'm allowed to keep going, so for many years, I was a consultant with IBM. I've always been a professor. My dad used to say, get out in the real world. So I did up to 15 days a year of consulting, and I was a consultant with IBM. Are any of you familiar with net present value models? Okay, so a couple of hands went up. So net present value models require you to figure out the future cash flows, bring them back to the present value, and compare it to the cost of the investment. And so I'd go through these net present value models, and it was all engineers. Okay, these were senior engineers. This is back before everyone was getting MBAs. Okay, and I would talk about net present value, and they would say, well, how much should we put in the cash flows? And my answer was very similar to what I just gave you for the Gordon-Loeb model. My answer was, I can walk you through it, but it's your product. You got to figure out what you could lose or what you could gain by going into this investment. All right? And I can walk you through the steps, things you want to consider. I could do the same thing with our model, but the numbers you're going to have to come up with. So one of the things that a company in Washington, D.C. came up to Marty and I, a major consulting firm, and I was friendly with the owner of the firm, and basically what he said was, why don't we take your model and go out to all my clients, and you can tell them how much they should be investing in cybersecurity, all right? And what we'll do is we'll give you a very attractive consulting fee, and we'll charge the client, okay? And that, on the surface, sounds like a nice idea. My reaction was, what are you, nuts? No matter what number we give them, it's not going to be the right number if they have a breach. What you want to do is, and we don't want to do it, we weren't looking for consulting, what you want to do is you want to explain to them how they can use the framework, how they can do it in their own company. So that way, okay, if there's a mistake, it doesn't work out, they're responsible for it. And remember, all these models of expectations are based on what we call distributions. So if I could have 100 repeated trials, it'll work out nicely. That would be the equivalent of saying, if I can put my model into your company for 100 years, it should work out better than not using the model, but I'm not going to get 100 years. If you have one big breach, the number's wrong. So So the answer is, I can walk you through how you'd go through coming up with your company, but I would never give you a number. I might tell you, well, let's look at the stock value of your company, okay? And if you had a big breach, what do you think you might lose? You know, what might happen to your stock? We do have evidence of what happens to company stock, right? We can look at the percentage you might lose on average. Might lose 2%. Tell me what that's worth to you. So there's some, we can certainly walk through and say, what kind of security do you have right now? What could you do to, you know, complement that by adding to your security? What do you think it would cost in your company? So I can walk you through it, but I would not give you the numbers. Because whatever I gave you, whatever numbers you come up with, someone over here in another company will come up with different numbers. Does that make any sense?
I can probably add something related, although probably not directly on the point. So I think one thing that's making cybersecurity really hard is because the attackers can come from all different ways. So there are so many vulnerabilities, sometimes we don't even know what is the vulnerability. So when we try to defend against all these possibilities, especially for small private company, we just don't have the resources. So that's why I think information sharing is very important. Once you know what is going on with your peer, then you can just kind of react on the first right at the moment. And another thing probably also makes more business sense is to wait a little bit to see what's really happening, then try to put your resource into the right spot. Although I know we have a lot of military people here, so maybe that's not the best case for defense.
Well, but what we see, we do see this. We see if a company has a breach, okay, I hear from CIOs and CISOs, Chief Information Security, all the time. You know, the easiest way to get more money is have some kind of a breach. Okay, so that's what Lay was saying, wait and see. Once they have a breach, boom, they can get money without no one questions anything, right?
Right, and the target case.
So actually, we actually have written papers on the value of waiting. It's called wait and see, but that's the deferment option. That was from the economics literature I was always publishing in, right? So that we applied the deferment option to that very thing. So what's the value of waiting and seeing?
So we've got one back here, and then we'll pull the box up front.
Good afternoon. Thank you for the very informative presentation. I've actually been looked at the model for quite some time.
Oh.
Forrest Hare from, by day, SAIC, at night, George Mason School of Public Policy, the Shar School. So you had mentioned two kind of classes of users of the model, if you will. On one side, you'd mentioned, for example, the targets of the world. On the other side, like a nation state. I would suggest for those two classes, it may be fairly easy to kind of codify what their expected loss is. On one side, it's everything. On the other side, it's stock values you mentioned to the stockholders, things like that. But I would suggest that in between, there's a very large class, which is, I would suggest, best example would be critical infrastructure sector, for which there are large negative externalities that are induced by underinvesting. And so have you considered how to extend the model such that they can internalize, the companies who's making these decisions can internalize those negative externalities from a national security perspective, because ultimately that is the issue that we need to be working on here today.
So the answer is not really, but we have done something related.
Here you go.
Okay. Okay. Oh.
No,
So we have done something related. So DHS supported us for 3 years. And one of the things we came out with was a paper on, which was published in the Journal of Cybersecurity, on incentives to do something along the line. And we talked about externalities exactly in there. In fact, that paper won an award from NSA. Even though DHS supported it, NSA gave us an award for that paper for its scientific contribution to the literature in cybersecurity. The reason I emphasize scientific, because most people don't think people in a business school or economists doing scientific work like the computer science people did. But the answer to your question really is explicitly no, that's a great idea. Some of you know we ought to get together, and that would be a good extension. We talk around it, we have papers on externalities where we actually modified our model explicitly to include externalities. But we don't exactly address the specific. We have stuff that we've gone around it, but not dead center. At least, would you agree? Or
Yeah, because of the externalities, it's one reason we believe firms are underinvesting, right, in critical infrastructure. On the other hand, we have another paper in terms of a chief information officer. If, on a personal level, if they have a major breach, they're going to get fired. So they might have incentive at least to argue for more. Okay, and we see that in things like Target, that when there is a breach, people get fired, even though the company doesn't go bankrupt.
Yeah. So related to one of the things I had another slide which I deleted the other day, and the other slide was why is it so difficult for companies to justify cybersecurity investments relative to many other investments? Well, it's simple. The name of the game for corporations that are publicly traded is revenue growth. And cybersecurity investments, for the most part, okay, some people argue you can gain business. Maybe in the early years you could. But for the most part, they're what we call cost savings, or what the government often calls cost avoidance of projects. Okay, so if you can invest $10 million, okay, to avoid $20 million in costs, the net increase is $10 million, right? Okay, so but it's a cost savings. The revenue hasn't changed. But if you can invest $10 million to generate $20 million more in revenues, okay, that's what everyone's looking for. Revenue growth projects, hands down, always win out over cost savings in general, unless it's what we call a must-do project. So there's lots of natural impediments to why it's difficult to justify in many corporations, profit-oriented firms, investments in cybersecurity. What Marty said was externalities is another one. Corporations, they only worry about what we call the private costs. They don't worry about the externalities. Well, the combination of the private costs plus externalities is social costs. Everyone talks about social costs, but what they don't realize is it includes the externalities. Private companies, okay, for the most part, don't know either. They don't know how. They don't take that into consideration. So there's we've written papers on why is it so difficult for firms to actually make these decisions to invest more. So I can tell you, the Department of Homeland Security, when they were supporting us, they were very concerned about this. There was clear understanding that on average, it's probably fair to say, it's a generalization, it's hard to prove because that companies, okay, are underinvesting in cybersecurity. But I can't prove it, but I can tell you, I can give you lots of good reasons why that would be the case.
Let me just add, in terms of cost savings, even within the category of cost savings, cybersecurity is particularly difficult because after the fact, you can't measure what you've saved. Okay, so because if there's no breach, you have to estimate what would the loss been if I didn't make this investment. So that's a hard case to make.
You'll have to forgive me because I'm not an economist. I am a cyber practitioner, and when I come out to more defense-oriented conferences like this, I try to put on my red team hat. I was going to sort of address the same thing that he did about externalities, but more from an attacker's mindset. So in the case of your model, if you also have people that are trying to get into your network and get the information within your network, they have some sort of inversion of this model, right? How much should they spend given how much the information is worth to them? In a situation where the information is actually worth more to an attacker than it is to the defender, given a free market, the defender would just sell that information because you now possess information that's worth more to someone else than it is to you. Obviously, that's not tenable in a situation where you're trying to defend your reputation and your organization. So how do you deal with the fact that the same piece of information can be worth different amounts to an attacker versus a defender in the situation?
I think that's all yours.
You get one thing, tough one. We don't have a simple solution, but let me sort of talk around the question because I don't have a good answer. But I can tell you that if you remember, when I opened up, I said originally when I went to Marty Loeb and said we need an economic model, he said I'm not interested. The way I got him interested was very simple. The first paper we wrote actually was a game theoretic approach to cybersecurity. Exactly your point. There's a game going on, right? You're trying to break in, and we wrote a little paper, and the way I got him interested, because he is a good method, I said, there's a game theoretic aspect to this. And all of a sudden, the bells went off, and he said, oh, there's a mathematical model here. But we don't have a good, because the problem is that there are different players in the game, and you're asking about how would we generalize to all the different players. And, I don't,
It's in the probability of attack. It's internal to determining the probability of attack.
Yeah, but
Right,
it would differ for different attackers. That's
But we
yeah.
don't have a model, although it's been models of attacker and defender. And it's a game that it's, you know.
Come up with your calculation of your expected loss and all that. There is a component of there is
Yeah,
probability
Yeah.
of that.
But once you introduce how much to invest, then there's another
stage.
stage, right?
But you could do it, yeah.
Right.
So I think what the hacker gain from the attack, it will be a loss to the society, right? So if we fully incorporate the externality of the cybersecurity loss from the whole society, maybe we can apply the model. That means everybody, the small business or the private business, they have to consider the whole society loss. So someone, since the hacker gained something, then someone else must have lost it, right?
So I encourage you to take 3 minutes, go back on your own and look at my little video. Because at the very end, what do I say? It's not a panacea. It doesn't solve all these problems.
Show it to your kids.
I-
My granddaughter loved the bear.
It's not a panacea. It doesn't solve all the problems, and so it's a way to it's got a lot of traction. To our surprise, when it started off, we didn't realize this was going to happen.
This is Min Xue from MasterCard. In my last company, I come from Rise Media, which is AO and Yahoo merge. And so, follow the data breach, we applied the NIST Cybersecurity Framework. I think this is a good model for total investment. Do you think this model can help the CISO decide where to invest? For example, they have 5 functions like identify and detect, right? And total have like more than 800 capabilities. Even for a larger company, they don't have the total all the functions. You feel like there's some functions don't have level 0, some functions have level 3. Do you invest at level 0, 1 to 1, or do you invest at, from 3 to 4? How do you think this model can help the CISO make the decisions?
Right, why don't you take it?
So it's got to restate the question.
So it's like you have a
Are
total.
you
like
talking about the tiers, or just where you invest?
You talking about the 5 functions on the core?
Yeah, you see, like say for example, I have our regular CFO approved $100 million to invest in cybersecurity, but I have 5 functions total. Like for example, just for simple, just 5 functions. But some functions, like say identify, I already have maybe level 3 now. But for response, I may have level 0 now. Should I invest it more on identify to get a level to 3 to 4, or should I invest more on the response from level 1 to level 2? What's the loss, right? Because all these functions is try to protect the information, right? But
So one of the things that we have talked about over the last few months is that most of the focus of the cybersecurity literature has been on prevention, and recovery is real. So that's I'm going to use prevention versus recovery, and recovery is really important. One of the things I've now come to believe, no matter what you do, you can't have 100% security. So what you want to do is when you think about your optimal investment level, you want to think about I think I'm addressing your question. You want to think about, so how much do you invest for protection, prevention, how much do you invest for recovery? You said you got 5 functions, but and so you have to, I don't have an answer for your company. I know, and we don't have a model for that, but we've been talking about something like that. So I think that's what you're asking. Is that? Right. Right. Okay. So yeah. So I think you're talking about the NIST. So NIST under the core has 5 functions, right? Actually, a small consulting firm last month came to see me, and I had lunch with them. They took my offer, come up to campus, I'll buy lunch. All right, and they wanted to apply our model to the 5 functions. I didn't want to tell them the paper we have that's about to come out, okay? But we applied it to the tiers. I think the tiers was a better way to look at it, because the tiers talks about the level of sophistication and rigor, okay, that you're going to put into cybersecurity, and it also talks about the cost benefit of moving from tier 1 to tier 2. When you talk about the 5 functions, they kind of merge together, and it's hard to separate them, and I didn't see how it would apply as well, but that's what they actually wanted to do, exactly what I think you asked me. They were asking, how can you take the model and apply it to the 5 functions, okay? And I didn't tell them, I said it would be tough. I didn't tell them that we've applied it to the tiers because I didn't want them taking my idea. I'll give it away once it's published. I'm not looking for consulting, okay? but I didn't want them to take the idea and start writing it up. It's, the person who heads up the company is very smart, and could easily, start writing up stuff on this.
So again, the model predicts an optimal amount to spend, and how it's related to tiers is wherever you are, that's going to be the tier. But if you want to move to the next tier, you're going to have some additional benefits. Right. And I think the tiers, the benefit of the NIST framework and its use in the government is firms are going to see that there's some benefit of moving to the next tier in terms of contracting, and they've got to estimate what that is, getting more government contracts, and that can push them to the next tier. Okay. I think there was one in the back.
So, isn't there a very big issue around information governance and information asymmetry? So first, from within an organization, the model seems to me to presume, at least, that an organization has a capability of understanding its own data and understanding the threats to that data. And I know someone spoke earlier about small and mid-sized businesses. And I think that the idea of information governance and the SMB, vertical are almost in opposition to each other. SMBs don't necessarily have that ability or capability to engage in that information governance to then do all the tremendous work in the model. And then secondly, isn't there an even more structural information asymmetry between an organization saying, these are the vulnerabilities and threats that I'm aware of and I can defend against, but the criminal coming to break into my system is always looking to expand beyond those known vulnerabilities. Operating in the known known is not where cyber actors really want to be. They want to be in the unknown unknowns, or at the very least, the known unknowns. So how do you combat both the kind of internal lack of information governance and the informational asymmetry?
Every point you raised, I agree with. It's not a panacea. I mean, every point you raised is absolutely valid. I agree with you 100%. And I can't solve it for your company, and you're absolutely right. I have to be honest, we've been applying it to large companies. We were somewhat surprised when the Better Business Bureau came out with their report and recommended for all small. But what you see with a lot of small companies, they do outsourcing. So one of the things I've recently, actually last week I had a conversation, it seems to me this would be a perfect project for the Small Business Administration to support, the notion of helping small businesses figure out some of these questions, right? And maybe hire some of these consulting firms that do cybersecurity to go out. In other words, Small Business Administration pay the consulting firm to pro bono. The small businesses, when you talk about small businesses, many of them are 5. Let me give you some numbers. At least this is the numbers I was given. But Small Business Administration says that, the Better Business Bureau says 97% of businesses in North America are small businesses. Now they define small businesses starting off with 0 to 5, 5 to 10. A lot of them are really small businesses. And someone told me, and you could correct me if this is wrong, that roughly 40% of the GDP, comes from small businesses. Actually, I thought it would be less, but I'm told I was given a number of 42%, actually. And so what I really think, the points you just raised, I agree 100%. They don't have the resources to do this. They don't really know what the value, what is it going to cost if I get a breach. And you need someone who's kind of better trained in that area. And I basically recommended this would be a great place for Small Business Administration, support consulting firms to pro bono go out and help the small businesses. Trying to get at I think I understood your point. So if you got any consulting firms here, I'm on your side. Okay. Okay. Yeah, I don't want to do it. I'm saying this would be a great place to basically make a case with the Small Business Administration that you support our project and we'll help small companies, based on your money, the government's money. So I think that's really needed. Because what do most small businesses do? They do what people do on their home computer. They get online and they download some software. That's what they do, I'm told. Right?
Can I just make one more point before we move on? So I think the model is actually in an ideal situation where you get to decide how much you want to invest optimally. But in most business, you actually receive a budget, just like what you have mentioned. So I think the most important intuition from the model is you need to identify where's the most profitable function or whatever you call it to spend your next dollar. So. Right.
Sometimes you cannot hide a certain area talent.
Right. And sometimes maybe it's like the point I was making earlier. Maybe it's better to wait for more information to arrive than to start to look at all the front, right? Yeah.
So I guess my question is, how portable have you found that 37% number to be? Because it seems like a lot of investments would have sort of that logarithmic, diminishing returns. But it also seems like within cybersecurity there'd be some things that are sort of have independent probabilities and costs that you might not want to lump in with all, specifically you guys say data breaches. You talk a lot about data and the value of data. What about like denial of service attacks? Those are very quantifiable costs when they happen, and they have quantifiable probabilities of happening, but maybe it's independent of the rest of our cybersecurity costs. How would address that? So
Okay. So my answer would be, I'll go 37. Okay, first of all, 37%, as Marty pointed out, would be the maximum, 1/80, maximum. Okay, don't run out and spend 37%. Okay, of your expected loss. For most cases, you don't want to spend that much. Okay, and so it's you've got to figure that one out. But don't run out and spend 30. I've had companies say to me, "Well, should we be spending 37%?" And I say, no. I say, you got to figure it out. All that, what we were able to show is a mathematical solution that the 1/E, okay, was a closed form solution that gave us a nice little decision rule. Okay, but that's the maximum. You can't run. So companies don't run out and do that. No.
It's not absolute in the sense that our model is looking at risk neutral.
Oh, yeah.
Okay, so if the managers, and there's lots of cases where you want to be risk averse. Okay.
It could be a lot more.
Right.
You could spend more.
Right. So a PhD student at Stanford in computer science wrote to me and said, I'm thinking of taking, this is about 3 years ago, taking your model, okay, and bringing in, and dropping the assumption of risk neutrality and bringing in risk aversion. And he says, are you interested in writing a paper with me? I said, no, it sounds like an interesting PhD paper. Go ahead and do it. But to me, that was just tweaking our model. But we know what it'll do. You'll spend more. We know where they're going to end up, right? And so I said, well, it was nice to see someone at Stanford wanted to, write it. I didn't recommend he do it as a dissertation, but it was a nice research paper if he wanted to do it.
So one thing you brought up just a second ago made me think of one other possible extension or area to look at is, so although I can't imagine anyone in the DoD acquisition leadership of actually having read my dissertation from 10 years ago, but they've begun implementing one of the recommendations, and that is through the, as you may be aware, that they're now requiring defense contractors to have CMMC levels that, getting real with required cybersecurity, tailored cybersecurity levels, if you will, in order to compete for contracts starting in the spring. So it's actually, very specific rules now that are based on kind of the NIST, but NIST and the CMMC. So it might be interesting, with that being a forcing function now, to see if that's actually, because that level of investment probably exists somewhere on your chart, and if it's a level that's higher than the expected return, there's probably going to be extreme disincentive to really go all the way up to that level. And if it's below, it might speed up to that level and unfortunately keep people from investing up higher. So it might be interesting to see how that type of contractual requirement may impact their spending decisions.
I think it's a great idea. So I'll buy lunch if you come up to campus.
Yeah. Gotta find the time to do that now.
Yeah, it's a great idea.
So on the question of risk aversion or risk tolerance, what about a concept of learned helplessness, where businesses aren't accepting risk or they're not averse to the risk, but they kind of live in this world of, very scary. It's very bad. I'm aware of this. My CISO's aware of this. Whoever's responsible for my IT is aware of this. But as an organization, I can't really start wading into the waters because they are so massive and I'm going to drown. So I'm going to play ostrich rather than that. I mean, it's not a question of allocating risk and kind of tweaking the model. There seems to me a kind of structural incompatibility with traditional notions of economic risk. People are aware, but are doing kind of almost like reverse prospecting. They're anchoring themselves away from the risk because it's just too much to deal with at a psychological level.
Yeah, you're right, but I would look at it a little bit differently. I would say most companies, we're talking about cybersecurity here, this is a conference related to that, but that's not why they're in business. Most executives, they don't walk around thinking about cybersecurity unless they're the CISO or the CIO. They got other things to worry about unless they have a breach, what Lay was talking. So you're right. I would say for different reasons, this is not on their radar screen, at least in the past. Now it's becoming, on the radar screen of all people. Now there's a lot of people arguing it should be moved up to the, board of directors because the breaches are so common and potentially, really, costly. And so when Equifax, are you all familiar with the Equifax breach? When that happened, so in the classroom I said, I don't want to see any company go under. But it looked like that company that was such a breach, this could be it. And this could be the big bonanza we're all waiting for, and everyone's going to wake up. I was wrong. They bounced back, right? They got other things to do. Now, they should be concerned about it, and other companies are concerned about it. But you're absolutely right. It's not the number one priority.
It's also just a basic criticism of economic models. I mean, right? I mean, we have a lot of assumptions in there that, the decision maker knows all of this stuff.
Remember my dancing line, right? Economic models should be used as a complement to, not as a substitute for, sound business judgment. And I'm using the word business judgment to mean sound managerial judgment, right?
Well, I think we've got a few minutes as we close up. One of the things I'd be interested in hearing is where you think that the field of research is going to be going next as far as the cybersecurity economics. Where do you see it going?
Okay. Well, one area it's definitely going, and actually Marty and I wrote probably the first paper in this area in 2003. So if you would have been, if I would have been giving a talk in 2005, I would have told you that cybersecurity insurance, is a fundamental way of transferring the risk. And I would have said about 5 more years, we'll see cybersecurity insurance really being a mature industry. Today, it's becoming a really mature industry. And I see, I see one area I see really moving towards is figuring out ways to transfer the risk through hedging, through cyber insurance. And cyber insurance, in my opinion, is now finally coming of age. Now, so I say within 3 to 5 years, it's going to be mature. I would have said that in 2005, right? But now I really believe it, I think. At least I got some evidence to say that they're collecting enough data. They need actuarial data. And I think, so in answer to Andy's question, I would say cybersecurity insurance is one of those areas, and there's really the economics of transferring it. So I have
beyond transferring it too. It's to provide an incentive that these firms, instead of standards, they have to have, in order to get a reasonable deductible or to be insured, they have to have certain policies in place.
Right.
Okay, so that's one area.
Another area is that what a lot of you folks may not realize is that one of the things that's given tremendous impetus towards companies being concerned about cybersecurity is the SEC disclosure guidance that originally came out in 2011 and was updated in 2018. So the SEC now is actually on board saying that companies should be disclosing their cybersecurity risk and cyber instances. I'm pleased to report I was involved when they were coming up with that in 2011. So that's one thing. Another thing, when I testified in front of Congress in 2007, I argued that it would be nice if we could tweak the Sarbanes-Oxley Act, what we call SOX, right? And in the Sarbanes-Oxley Act, on Section 404, they talk about internal control, okay? And they talk about the notion of internal control should make sure we have reliable financial reports. Well, I argued in front of Congress in 2007, you cannot have reliable financial reports, okay, if you don't have secure information systems, if you're operating in a computer-based environment. Everyone operates in a computer-based environment, so to have reliable financial reports, you need secure computer-based systems, and if they're not reliable, they're not valid. So reliability and validity. And so that's an area where people now, the accounting profession, is starting to recognize this, okay? So in 2018, the AICPA, American Institute of Certified Public Accountants, they finally now have gotten on board. When I talk to the accounting firms, okay, we're in an accounting and information assurance department, in 2000, they would say to me, well, cybersecurity is important, and I know that, but that's not what we're really into. Now they're hiring computer science people because they realize, okay, there's an opportunity here. So now they're talking about a cybersecurity reporting system, okay? And so I know my friends in computer science say this when I say it, but who do you think is putting in a large share of the cybersecurity for computer systems in major corporations? It's the auditors, the accounting people. Okay? At first, what they were doing was they'd hire 1 or 2 computer science people for maybe 100 audits. Now they're hiring a whole slew of computer science type. Right? And when I would say that to my friends in computer science, they say, that's crazy, and I agree. I think people with the right kind of computer science background who understand encryption, things like that. I mean, so I gave you a couple areas where.
And I guess not so much specifically cybersecurity, but the relation between cybersecurity and disclosure, related to what you said, that the effect, in these annual reports, they have to talk about cybersecurity risks now, and they all do, but it's boilerplate. You don't learn much by reading the annual report, they're saying.
Unless they have a breach.
Yeah.
So here's the deal. So if you go to Target had a big breach year off at the end of 2013, right? If you look at their 2012 10K, you'll see a couple paragraphs on cybersecurity. Okay, companies like Target, retail companies, they file theirs at the end of January, February 1. Okay, so they have through February. Their big breach was in 2013. If you look at their 2013 10K, which goes through January of 2014, I've added it up. I discuss it in class all the time. In different places, roughly 7 pages of their annual report of the 10K are devoted to something about their big breach. Come the next year, it went down significantly, and if you look at it today, we're back to kind of standard stuff. So now that's why the SEC has gotten really involved in this. So 2018, they came up with another disclosure guidance by the commissioners. It's what they call a commission. It's not a regulation at this point. So in 2011, it was the Corporate Finance Division that came up with the disclosure guidance. In 2018, it was the commissioners of the SEC that came out with disclosure guidance. So they're moving in a direction of serious disclosure. And as someone who's trained in economics, we hate to say we want to see regulation, but I really think we need, probably being taped here, we may need more regulation in this area. That's the bottom line. Without it, and I always make the analogy of seatbelts, right? You may not like that analogy, but if any of you were around when we weren't required to wear seatbelts, most people didn't wear them today, and most people didn't want to buy them. Right.
Option in the car.
Yeah.
Did you have anything else you want to say as we close?
I guess I would say we definitely need more data, like the audience have mentioned. And I think it used to be the company doesn't really want to tell us anything, but it is doable because we see insurance companies getting more and more data. They're able to get out more reasonable insurance policy. So I think we definitely, as academia, should move towards that direction.
Yeah. I should mention one last thing, and that's the GDPR.
Right.
The General Data Protection Regulation in Europe is really pushing the needle further over, and all other countries are starting to look at the U.S. in particular. So I think that's one of the real big developments. So if you're familiar with the GDPR, most of you, that's been a real key issue. So there are real movements taking place.
Anything in closing, Marty? Yeah, okay. Well, I thank you very much for, I hope everyone enjoyed the panel as much as I did, and thank the speakers.